Okay, guys, tonight I'm going to give you an overview of the single family home retirement strategy and what's in it for you, which is a lot. And I think you're really going to be amazed at what we show you here tonight. This is going to be a series. There's just too much to cover. So next month's webinar, we'll be getting into the actual process, or what I call getting into the weeds, and how we determine what you can buy, how we analyze it, and how it all works as far as in terms in detail. The following month, we'll get into how we rehab property and how we rent the property for you. The month after that, we'll go into how we manage the property, and you'll also see how you manage your cash flow on the property, which is critical. Last month, we talked about having a checking, savings, investment account, a separate account for your real estate investments. We nicknamed it the piggy bank. Some of you may have remembered that, and not to rob your piggy bank. And we have some fun with that, but it's a very serious matter. And then last in the series of the single family home retirement strategy, we're going to be talking about our software. It's very easy to use. When I had it designed and developed, I made it where a third grader could run it. I like things simple, to the point, and we actually have video training on every screen. And so it's just a no-brainer when it comes to having that. By you following your portfolio with the software, you're going to stay motivated to keep your real estate retirement going. Without it, you kind of can lose interest, because it's kind of like out of sight, out of mind. How am I doing? Oh, well, I don't know. I guess I'm doing okay. You need to know how you're doing at least year to year, if not even more so. So lastly, we will be going ahead and having a video of a number of different people that are actually in the program and how they've done. And you're going to hear from them, not just me, but you're going to be hearing from them on what they think of the program and how long they've been in it. So with that said, we're going to get right into the single family. We call it Management One's Monopoly game. And it really is a fun program. And I do want to make certain right up front here that we are not financial planners. We only plan out your real estate investments, but we are not financial planners. So just make a point of that. Okay, let's give a little, as far as the topics, we're going to talk a little bit about the history, how single family home retirement strategy was created and when, reasons to consider it, also the overview of the single family home retirement strategy. We'll also be showing you how we will get you there. Okay, this is a very methodical step-by-step process. And then also I'm going to be showing you actual cases, what other landlords have done. One of those are going to be tonight. You're going to probably be pretty amazed when you see it. And then what's in it for you? Because at the end of the day, really, it's all about what's in it for you as an individual. Not about us, but about you. And we will share that with you. Okay. The history of the single family home. Actually, I created the program in 1980, believe it or not. And in 1982, as a founder, I taught this program nationally to RE/MAX agents and brokers across the country. And pretty amazing, pretty amazing. In 1989, I continued buying properties for myself and the clients using the single family home retirement strategy have as well. I have a number of properties in different states as well as California. In 2011, we had the software created because before then it was very difficult to update everything and find out where you're going and how this year compared to last year. And so the program, the software program, is just essential if you're really going to want to build your portfolio there. Okay, and so all of this brings us to today. And so the first thing I want to get in here is reasons to consider it. You see here, only 15% of Americans have retirement assets. And what's really scary at the bottom of the screen there, you know, people that are near retirement, only $12,000 in savings. And we all know that's not going to last very long, right? So it's pretty much a no-brainer that you need to have some kind of a retirement and not just rely on your company's retirement, but or Social Security, and who knows if that's going to be around, right? We don't know, or if it is going to be reduced. So this is a way to be able to basically fund and make sure you have not only a retirement, but cash flow at retirement, not just assets. Okay, so Tyler alluded to this, but the perfect storm is now. I hear people saying, well, I don't know, interest rates went up 0.5 point or down 1/4 point. Should I wait? The answer is no. I tell people today, you can take an arrow and throw it at something and hit a house and buy it, and you'll still do fine. Okay, you really will. You can't miss at a 3% interest rate. Okay, we got, rent-ready inventory, high demand, which we've already talked about, inflation on the horizon. Every indicator is to buy now. For an example, Chrissy was saying, let's say 425,000. So a house of 400,000 at 8%, that means that house is going to go up $24,000 next year. 1 year, it's going to increase $24,000. So think about that for a second, because we'll get into it a little bit later. But remember last month I talked about leverage. You're leveraging. So if you put in 100,000, as a down payment, and you buy a $400,000 house, you're making 8% on 400,000, not 100. But if you leave your money in the bank, you're not even going to get 8. You're going to get 1, maybe 2. Okay. And so look at the difference on what's happening there. So yes, the time is right now, definitely. Okay. Some of you may know this guy. He's pretty well known. He's the 3rd richest guy in the world, Warren Buffett. Okay. But we're going to watch a clip where he talks about single family homes. So it isn't just me saying it and talking tonight, but I want you to hear from a guy that's worth in excess of 50 billion. So let's go ahead and play it, and we're going to mute ourselves temporarily. And Kristen, take it away.
If I had a way of buying a couple 100,000 single-family homes and had a way of managing, the management is enormous. It's really a problem because they're one by one. They're not like apartment houses. So, but I would load up on them, and I would take mortgages out at very, very low rates. But if anybody is thinking about buying homes, 5 years ago they couldn't buy them fast enough because they thought they were going to go up, and now they don't buy them because they think they're going to go down, and interest rates are far lower. It's a way, in effect, to short the dollar, because you can take a 30-year mortgage, and if it turns out your interest rate's too high next week, you refinance lower, and if it turns out it's too low, the other guy's stuck with it for 30 years. So it's a very attractive asset class now.
If you are a young individual investor at home and you have your choice between buying your first home or investing in stocks, where would you tell someone is the better bet?
If I thought I was going to live, if I knew where I was going to want to live the next 5 or 10 years, I would buy a home and I'd finance it with a 30-year mortgage, and it's a terrific deal. And if I was an investor that was a handy type, which I'm not, and I could buy a couple of them at distressed prices and find renters, I think that's, and again, take a 30-year mortgage. It's a leveraged way of owning a very cheap asset now.
Okay, so we'll go back to the slide now. Okay. And that just gives you an idea. He may not be very good at maybe fixing a toilet, but he's done pretty well with investing at 50 billion. So, but that just gives you an idea from a very broad perspective. And what happened in 2008 when a lot of this came down, a lot of your companies out there, they always looked at single family homes like, oh, it's just a single family home. And after they really saw, as Buffett did, people went out and they put mutual funds, thousands, 30,000, and put it in one mutual fund, okay? And that's what they did, and they made billions on that. So you can do the same thing. We're just going to do it at a little smaller scale, okay? And by the way, as I'm going through this tonight, if we have landlords or investors who have 10 or 15 properties or 20 properties, we can take even further, okay? So we made this on a lower scale, but if you have a number of properties, don't think this program's not for you, because it is. Okay, so let's look at this. How do we retire with $14,000 a month and have $4.3 million in equity in 6 properties that are free and clear? Do I have any takers tonight? Okay, all right. So let me share with you how this program works. In this scenario, we're going to use 6 properties. You don't have to do 6. You could do 1 or 2, or you could do 32. Okay. But for presentation purposes, we're going to go ahead and use 6 properties here. So basically what we do is we go out and buy the first property. Normally we would do this over like a 5-year period of time. Okay. To buy these number of properties, 4 or 5 properties, in this case 6. Okay. And what we do is we buy the first property, keep it a year, and maybe because it appreciates a little bit, we can pull some money out of that, or pull some money from other assets you have. And then we buy the next property, and we buy the next one. And after we get the 6, everybody says, well, should we sell them? And the answer is no. In this single family home retirement strategy, it's a buy and hold asset. Okay. That doesn't mean you can't buy house number 7 and buy and flip it if you want to. Okay. But in this, it's hands off. It's like your 401k. All right. And so what happens is once we bought all 6 houses, then at that point, as rents increase, which lately they've increased dramatically, okay, what we do is we take that extra capital and we pay down the mortgage on the first property. As soon as that property gets paid off, then we take all the money from that first property, because now we don't have a mortgage, right? Okay, and we start paying down the second property along with the rents increase again, because every year the rents are increasing. And we just keep until all 6 houses are paid off. It's a very simple process. This is not complicated. Okay, actually, it's less complicated than Monopoly. Okay, to be honest with you. All right, and so that's how kind of an overview there. Here's the beauty: you, the client, you own it and you control it. Okay, you can have us work with us, you can have us manage it, or you can have somebody else manage it. Okay, or you can manage it yourself. Now, one of the big subjects that always comes up in the topics is, well, does this only work with houses? No, it'll work with condos, it'll work with apartment units and commercial. The difference of it is you want to have more than one item, because I get asked a lot, well, should I just buy a large apartment building instead of 6 homes? No, and here's why. Because at retirement, if let's say something catastrophic happened and you had to sell in order to take maybe care of a loved one or something. If you have a big apartment building, when you sell that apartment building, you lost your cash flow, you created a massive capital gains tax, okay, and you're in a downward spiral. If you have 6 houses, you sell 1, you take care of the situation at hand, and you still have 5 paying you. I hope that makes sense. So if you want to buy apartments or commercial, that's fine. But instead of having a few $100,000, you're going to need a few million. So it just depends on what league you're in, and everybody's a little bit different. But that would be sorted out when you talk to Tyler or Chrisia in a private conference there. Okay, any questions thus far?
Yeah, there's one.
Mm-hmm. Is there a new tax law? I'm sorry, is there a new law that would tax at market value properties that were passed down to family heirs through a trust?
Well, a family's going to get a stepped up basis is what they're going to get as it is now. What the new laws are proposed, I can't, really respond to that. Okay. But as of right now, the family members, they would get a stepped up basis. What that means is basically, if I have a property and let's say I sell it for $1 million and I bought it for 500, I'd have a $500,000 gain. But if instead of selling it, if I die and it goes to Tyler, he gets a stepped up basis and all that gain is wiped out. Okay. So that's how that works. Okay. All right. We'll continue on then.
Well, really quick on that point too, and correct me if I'm wrong, isn't it important that, let's say it is passed down from an heir who passes away, to get that property, if you're the trustee, to get the property appraised at the value it's at?
Yes. Within, I would say 90 days of somebody passing, you should have an appraisal done on it. So the IRS can't come back later on and contest it, that you're saying is worth X and it is really worth a lot less. You know what I'm saying? And so that
in terms of for the gain, because
your gain starts from the day I would die. That's how that works. But within 90 days is fine. You don't have to go down the week after and do it. That's not a problem. Okay, next, let's go on here.
We do have one more question, Ron. It says, how would you how would you leverage this strategy if you own 2 properties now? Would you mortgage one to buy another?
Possibly. We would not be able to answer that until we saw a little bit more of your financials, because we don't want to overextend you. But the short answer is yes. We could go ahead and leverage one property and buy another one. Okay? And keep in mind, this is not, if you want to be on a fast track, we've had people come in and buy a lot, but normally people do one property the wait a year, buy another one. Okay, and that's okay. You don't need to be on a fast track to make this work. And you're going to see in just a few minutes here what I'm talking about. Okay, we're going to move on here now. How will we get you there? Well, a lot of time, a lot of years have been put into this. This is something that I thought up in my garage a week ago. So this has been well thought out. So let's go ahead and we'll go to the first thing here. First of all, to get started, you'd have a complimentary 1 hour, normally it'd be a virtual meeting to see if it works for you. Okay, and there's a number of questions that we would ask you and information that you would need to give, our associates, Chrissy and Tyler. Okay, the next thing of it is here is one of our agents would help you find a property for you to purchase. Okay, I also want to point out that as long as you stay a buyer in real estate, are you aware that you never pay your agent a dime? Okay, the seller pays a commission on the property. So basically, you get all of Tyler's time or Chrissy's time and effort and knowledge for free. Okay, they don't cost you a dime, because the seller, whatever property you buy, is going to pay that commission. They're going to get half of the commission. The listing agent, whoever listed the home, would get their half, and then Tyler and Chrissy would get their half. So it's a beautiful thing. A lot of people don't understand that, but why wouldn't you not take advantage of it? Okay. Next thing of it is management one will provide a certified rental analysis before you make an offer. Why is that critical? You need to know what that property is going to rent for, and you do not want to go on Zillow and think you got a handle, because we've already checked that out. And normally Zillow is normally like 15%, more than what you're actually going to get on the property. Okay, so you got to make certain that you know what that rental data is, and we provide that, and there's not a fee on that either. Okay, as far as the certified rental analysis. Okay, the agents, they'll negotiate, they'll make the purchase for you, they'll set up the financing for you. We have lenders, if you don't have your own, which a lot of people don't, we can set all that up to get you the best rate. Then they'll take it all the way through escrow. Okay, they'll walk you all the way through it. They'll be in touch with you. You're going to see exactly what's going on. We spent a number of years working with people and vetted them, because we like people who follow up. And I don't think anybody on this call would disagree, right? Okay, we are big on follow-up. Okay, next thing of it is we got to make it rent ready with repairs. We'll do that through management one. We give written estimates, and we have fixed maintenance pricing on over 600 items in a house, and we update that almost every year. So we tell our contractors what we will pay them to fix, repair, or paint something. Okay, and because of our longevity, we are able to do that. Okay, then we go into, we'll rent and manage the property through management one, and yes, you would have a management fee there. It normally runs 7 to 9%, depending on what services that you like to take. And the other thing of it is, once it's there, management one, believe it or not, is going to call you every other month for life. Okay, and your agent, if it's Chrissy or Tyler, okay, they will be meeting with you a minimum of once a year, if not more, if you're very active in the buying program. And then the last thing is, as I alluded to earlier, we have the software so you can track and manage your portfolio. So you can see there's a lot of things that have already been set up and that are not only in place, but they've been in place for years, over 30 years. Okay, any questions at this point?
No.
Okay, we'll move right along. How do we determine what you can buy? Well, we would review basically whatever your current holdings are in real estate, like the one gentleman that just said, if I have 2 properties, can I leverage? We will get into that, okay? If you have rental property, we're going to look at the values of those rental properties. We're going to look at the current rental rates. In most cases, most people's rental rates are way low. Okay. Also, how many more years before you want to retire? If you want to retire in 30 years or 10 years or 15 or 20, we will need to know that to calibrate as far as your portfolio that's going to fit you. We also would want to know what you paid in federal and state income taxes last year, because that's something that we want to start reducing by owning real estate. And then also, how much are you leveraged overall financially so we don't overextend you, okay? And when I get to the end here, I'm going to come back to this leverage and I'll explain more what I mean by that. But basically, we want to make sure you don't get overextended. And just a few minutes, I'll touch on another slide and we'll come back to that item. Okay, this is just some rent-ready inventory that we've had in the Inland Empire. You can kind of see the type of properties. We like quality A-B properties. We're not into really C-D properties as far as to buy for our clients. These are some properties in the Orange County area that we have and that are currently under management as well, just to give you an idea of what kind of properties and visually what they look like. All right. So let's talk about what's in it for you. Because at the end of the day, like I said earlier, that's what matters, correct? So let's talk about this. Now, I know you can't read these numbers, but you will be able to read these numbers when Tyler and Chrissy sit down with you. But what I'm going to do is I'm going to bring on another chart in just a second. But first of all, this was based on looking into the future for 20 years. We put appreciation rate at an average of 6%, operation expenses of 3%, and rent increases each year about a little under 4%. So with that said, I'm going to bring up this, and this I know you can read. Okay. So this is going to give you, as I put in the slide here, an ends to the means. In other words, if we could look into a crystal ball, what could I be looking at in 20 years, right? So in this plan, it's to buy 6 properties in the next 5 years. Okay. It's not buying all 6 in 1 year, over 5 years. We're going to put 15-year mortgages on them in this scenario. Okay. And the value when we purchased would be $1.4 million. That's all 6 properties. Okay. Would total that $1.4 million. And the initial rents on the 6 houses today would be around $9,500 a month, or about $114,000 a year. Okay. Now we're going to fast forward. We have them all rented, right? And now we're going to look at 20 years later. So all of you just got 20 years older. I got 20 years younger. You got 20 years older. Okay. Okay. So anyway, the value when we purchased was 1.4. In 20 years later, those 6 properties are going to be worth $4.3 million at a 6% appreciation rate. Staggering. Okay. Now let's look at the next item. Rents when we purchased was $114 a year, $9,500 a month. Now they're $240, almost $250,000, or $20,000 a month. Okay. Now we still, if you have them free and clear, you haven't paid off, you still have repairs, management fees, property taxes, and insurance, correct? So you still got some expenses there. So if you take the 6 over 12, that's still $72,000 a year. That's going to go out just to go ahead and take care of those items. But keep in mind that $72,000, that's all a tax write-off. So you're really only paying about 60% of that $72,000, because you're getting the rest of that back on your income taxes because you own these 6 properties. We talked a little bit about that in last month's, when we talked about saving $2,700 on depreciation alone for every property that you own. So now let's look at the next step. Now you're at retirement. You're 20 years older. You have $14,000 a month coming in from just this. This is net, ladies and gentlemen. Okay, remember the 20 less the 6. Okay, so you got $14,000 or $167,000 a year that you have coming in on just 6 simple single-family homes. This is not rocket science. This is simple. Step 1, 2, 3. And again, your value, they're all paid off. So you have the value of $4.3 million as far as setting in your account. How many people today do you think have this sitting in their account at retirement? And we all know the answer to that, right? But this is simple. This is, especially working with us, it is super simple. Okay, because we're going to show you exactly what you need to do, and you're going to see testimonials. You don't have to take our word for it. Okay, any questions on these numbers?
Yeah, we do. Can an equity line be pulled from a property in a trust?
With the right people, yeah, with the right person. Okay, asset is an asset as long as they have the authority to do it. Okay, and that would be the kicker, as long as they have the authority to do it. Okay, but yeah, and we also recommend, as you would get started with us, is that no matter what money you have, we would still want to set you up with the bank to set you up with a credit line of 100 to 200,000. Now, why would we want to do that? Because if a great opportunity came along where you could take advantage of it, it might be advantageous to access that credit line temporarily, buy the property, and then put a mortgage on it. Okay? Because you got to be at the right place at the right time, right? And that's how we take advantage of that. Any other questions?
Yeah. The question is given the crazy prices in California, is it still worth investing in California? Do the numbers pencil out?
The numbers do pencil out. Now, in certain circumstances, depending on how much money you put down, in the first couple of years, you could have a little bit of negative cash flow. And sometimes people get all wigged out on that. But it normally lasts like 1 to 3 years, and then you get into a break-even situation, and then it goes positive. Okay, it just depends on your earnings. If you are very solid in your business or a company you work for, and you've got a lot of longevity with that company, and you know you're super solid, then you might be able to go ahead and handle a little bit of negative cash flow in the first couple of years, so you can get started. But let me say this as well: to get started, if you have to partner with somebody to have a half a house, then you partner with them. Okay. A lot of times you'd be surprised. You need to go to your grandparents. A lot of grandparents love to help their grandkids get a house and help them out. They will help you. Okay. And so that's another great opportunity as well. But if you can't, then partner with a business associate, a family member, and buy the first property together. And now you're launched. You know, next week, I'm going to show you, how much it can cost you by waiting. Okay. And when you see that, it'll really, next month, I should say, it's going to really wake everybody up. Okay. All right. We're going to move on here. Mm-hmm. Okay. Now we're going to show you an actual case of one of my clients. They've been with me over 30 years, Terry and Carol. Okay. Great people, just awesome. They bought their first house. They actually bought 2 houses in 81. The first house they bought, just a 3-bedroom, 2-bath. You can see it there. It's not any luxury mansion, but it's a nice, decent neighborhood, very solid. They bought it for $72,000, and the rental rate was $425. And look at the year. What do you think their interest rate was in 1981? It wasn't 3, ladies and gentlemen. It was a minimum of 13. Okay, so we got to put things in perspective here tonight. Next, today that house is worth $378,000. Okay, 5-6 times what they paid for it, and the rent has went from $425 to $1,700, almost over 4 times. Okay, and the cash per year coming in is $20,520 on that property. Okay, that's property number 1, and the property is paid off. It's free and clear. Okay. All right, next property. This was bought in 1982, kind of the similar. They bought it all in kind of the same track area, but you can see a very nice, well manicured, and a renter's living there. Okay, and you can see how nice it is, right? They bought it for $68, a little bit less than the other one. The rent was still about $425. Still shocks me when I see those numbers. I can't believe we rented them for that way back then. And now today it's worth $375,000, rent $1,725, and the cash is $20,000 as far as on that one there. Now the last one, they bought 3 over in 1981. Here's another one. They bought it for $72. Rental rate was the same, and now it's worth $365. Rent's a little bit lower on that. That is going to be going up very soon. because they've had a long-term resident in there. So that's probably going to bump it easy $200 a month, or they got about $18,000 a year coming in on that alone. One thing I want to point out tonight, ladies and gentlemen, before I go to the next slide, is we did analysis on these 2 years ago. Every one of these properties have appreciated $100,000 each in the last 2 years. So their portfolio increased $300,000 in 2 years. 2, not 22. So let's look at a summary of what happened here. Okay, the equity now is 1.1 million. Okay, cash flow year is just a tad under 60 G's. That's 5,000 a month, and the debt on the property is a big fat 0. Okay, do I have any takers? Yeah. Ladies and gentlemen, you can see how simple it is. It's not complicated. People make it more complicated than it is. And all I did when I started doing this, I go, this is simple. And so I just basically dumbed it down, if you want to use that word, and made it simple. Step 1, 2, 3, this is what you do. Obviously, you have to have all the infrastructure that I shared with you to make it work. Okay. But once that was there, it was done. Okay. Mm-hmm. And so how great for Terry and Carol. You know, they deserve it. Awesome. You know, and I could not be happier for them. Okay. Any questions on that?
Yes, we do. It says, why should I consider buying more properties when more cities are adopting rent control and laws that generally favor the resident over the landlord?
Well, you got a 2-part question there. Okay. And the first part, as far as on the rent control, believe it or not, on rent control, we are still raising rates. If you were in a webinar a month ago, you saw how just raising it $32 a year, how much it increased. But what we did is we put about 6.5% on it. Now, if you personally own it and you don't have it in a trust or an LLC or a corporation, okay, a lot of those rent controls don't affect you. However, let's say it does affect you. If you can raise rent 6.5% or 7% on a $2,000 rent, that's a $140 a year increase. Okay. All right. That's a high increase. If you can do that, you're still going to be fine. Okay. Now, your second question, you know, how they favor as far as a resident, or as we refer to them, we don't refer to them as tenants, but as far as tenants is basically that's always been there. Yes, it's got increasingly worse with COVID-19, right? They've come out with more laws and things. Okay. But myself, I still feel it's a good investment. And basically that's why if you have professional management today, whether it be us or somebody else, they'll help you navigate through that. In fact, on property management, people that are managing their properties like 5 years ago, a lot of those people are saying, you know what, this has gotten way too complex, you know, and they've turned it over to a management company to manage. But if you're going to have a management company, you need to vet them just like you should vet us should you decide to hire us down the road. Okay. Any other questions?
Yep. One more. It says, does your program support building new homes on vacant lots?
It could. Absolutely. If you found or we found you a lot and you wanted to build 3 or 4 properties on that, absolutely. Okay. It works with that as well. And like I say, it works with any asset class. It can be condos, apartments, commercial. It's just if you're going to buy a 50-unit building or a 100-unit building, or you're going to buy, let's say, a commercial building like a Walgreens. Everybody's seen the Walgreens CVS on the corner. Okay. If you bought that, Walgreens and CVS don't own those. Okay. They have 20-year leases on it. But if you're going to buy something like that, minimum, you're talking $2 to $4 million just to buy one. Okay. And so your down payment, you got to have a few million to play in that game. But ladies and gentlemen, look, Terry and Carol, they didn't play in that game. And how did they do? Mm-hmm. They did just fine, right? So you don't need to be a high roller. If you are, we can help you on that too. Commercial or apartments, whatever. That's not a problem. Okay. Anything else? Any other questions?
Yeah, it says, will this strategy work if you're already retired?
Yes. However, if you're retired, we're going to look at your overall leverage position because I don't want to over encumber you. Because if you're a young guy like me, you don't have enough time to recover. Okay. Okay. Where if you're like my son, that's 28, when I was 27, 28, I was highly, highly leveraged. But today, not so much. Okay. And so the answer to the question, yes, we can do that. But we'll be a little bit more careful depending on what assets you have and what your other retirement that you may have coming in that I don't even know about. Okay. All right. We can go to the next slide here. Okay. Let's talk about the software. Awesome product. Okay. You guys are definitely going to want to use this as far as down the road. Okay. Basically, it puts together a complete portfolio for you. This breaks out all your real estate, breaks down your mortgage, your interest rate. I know it's hard to see the screen, but don't worry about that. We'll get into it in the future webinars here. So that's your real estate. You can put in your stocks and bonds. We don't recommend that. We're not financial planners, but this information is for you to see. We don't see this. You're only going to let us see what you want us to see. Okay. So all this information here is going to be with you. We don't have access to that. Also, any savings accounts, you have money market funds, etc. Also, retirement, whatever you have in retirement could be with your company. It could be a Roth. It could be an IRA. And then what we also do is we actually it's a net worth statement. So it shows your assets and liability. And in this case here, it's hard to read that there, but this person was worth about $800,000. They had about $1 million in assets and about $270,000 in liabilities. And so now I'm going to talk about leverage again. You can't read this, but it's 23%. Okay. So case in point, if you're in your 20s, you could maybe be 70% leverage. I was even higher than that. Okay. Back then, people said to me, "You're going to lose everything." I said, "I have nothing." I really had nothing. And so I rolled the dice, but I worked hard at it. Okay. It didn't come without a lot of effort. But if you're 27, you can do that. If you're 57, 67, then you want to be less overall as far as in terms of being leveraged because you just don't have enough time to recover. But here's a good thing. If you're older, normally you have a little bit more assets than the guy or gal that's 27. Follow me? So a lot of times the assets you've accumulated can help offset the years, that you don't have. Okay. And so the last thing we have here is a cash flow statement. And some of you like me, some of you hate me for this, but it basically puts you on a budget so you can see what cash flow do you really have left over as far as at the end of each month and the end of each year. Okay. And we'll get into more detail on this as far as we go through it. So basically, as we start to wind it up here tonight, because we're a little bit over, I got a little homework for you before the next webinar, which will be July 21st. We will have this available. In fact, it's available right now. It's called tappable equities. What is tappable equities? That means that's equity that you could actually pull out to buy another property, as a gentleman asked earlier. So for an example, if you see right above the 75% of the value of the property, let's say it's $400,000, 75% would be $300,000. Let's say you owed $100,000 on the property. That means the bank would allow you to pull out as much as $200,000. Okay. And we have worksheets, and if you have more than 3 properties, just copy it and keep going and put every property you have into this worksheet. Okay, so this is your first homework. The next one, pretty simple. It's just a sheet to fill out whatever you have in savings or money market accounts, what you paid in federal and state taxes last year, any type of real estate retirement that you have now. It could be in a partnership called REITs. Real estate investment trust, that's what that stands for. And then we also would want to know how many years you have before you want to actually retire, because not everybody retires at the same time. Okay. In my consulting, I mean, I've had a lot of where the wives are, maybe retired 10 years earlier and take care of family business, and the husband's still working, or vice versa. So that's where that comes from as far as on there. So here's all the resources that we put together for you. We're going to wind it up here. Okay. Basically, this is you, the client here. And the first thing of it is you would have an agent broker like Chrissy or Tyler to go ahead and help you find the properties and take it all the way through escrow. Then you have management one to manage it. We'll set you up with a mortgage company. If you're doing a 1031 exchange, and that's a much deeper conversation, I'm not going to get into that tonight, but we can help you with that. Not only can we help you with that, I've done a lot of them. Okay. Insurance, we can help you with that as well if you don't have the right insurance on your properties, which most people don't. Legal, if you have any legal situations, we can set you up with that. CPAs, if you don't have a good CPA, we can set you up with a CPA as well. Also, to make the property rent ready, we have over 36 vendors that have, some of them been with us over 20 years, that can go in and make your property rent ready at fixed prices. Okay, I want to say that again, fixed maintenance prices. Okay. And then lastly, if you really do want to have a full-blown financial planner, we can set you up with that as well. But again, as I noted earlier, we are not financial planners. We are real estate planners. And that's what we thrive in, and that's what we do well, and we do it often. So next month, we're going to share with you the actual process. If you wanted to get started earlier, you don't want to wait the next 2 or 3 months to go through all this, you can contact Tyler or Chrissia, and Kristen will be sending out all the information, emails, phone numbers, and all that. You can contact them whenever you want. If you want to go earlier, next week, next month, and they will start you on the program, and they'll just put you on a fast track to run you right through the entire single family home retirement strategy to see if it's going to work for you, if you'd like to contact them a little bit earlier.